Hi, Paul Gerard from Price Accounting Services, back with another one of our business and entity tax matters videos. This one's concerning what we call Division 7A. Division 7A is an element of tax law which affects companies. Think of this simple scenario. Company A sells widgets and makes a profit of $300,000. The director, owner, shareholder doesn't draw a salary. He likes that the company pays 25% tax, as he would pay much more tax if he drew out the income. He does this for years without advice. The ATO audits him and queries his lack of income or very low income. They see that he borrowed from the company. He has drawn out the profits, called it a loan, and whatever he's done with it, and then he's effectively borrowed from the company. The ATO then raised the issue of Division 7A. D7A basically looks at the company's distributable surplus, let's call it the profit, for the year. To the extent that the associate has borrowed from the company, then Division 7A calls the borrowing a dividend. It's a payment of profits. It is assessable income of the shareholder, according to law. This raises the prospect that that person has avoided tax and has participated in evasion. Evasion does not need to be knowingly undertaken. It doesn't need to be willful. It merely just has the effect of evading tax. Therefore, the ATO has an unlimited period of time to review and correct the matter, and may impose an addition beyond the additional tax the company's already paid on its profits each year. It then imposes tax on the individual, plus penalties, plus compound interest at quite aggressive rates. And the penalty in such a case could be quite aggressive because of the evasion nature. The ATO would likely issue an audit opinion which says evasion has occurred and the penalty might be 50 to 80%. Another consequence of that arrangement is normally when a company pays a dividend, franking credits might benefit the shareholder to at least cushion and protect against double taxation. Division 7A isn't so kind. Division 7A cancels franking credits. You can't reinstate and put franking credits where they were not originally. The ATO would most likely also double tax and potentially not only deal with the matter as Division 7A, but also consider it is also a borrowing and tax twice. The reason they sometimes do this is to ensure the taxpayer settles and reaches a resolution so that the matter does not progress to appeal. So the taxpayer's on a hiding. They can't win. Well, rarely wins because it's easily proven. It's an easily proven offence. Division 7A, however, does have some remedies. And this is where prudent and great tax planning comes into play. So having a very proficient, experienced tax and accounting advisor really helps. If we had been asked, we would have advised on Division 7A and indicated the process to formalise each year's borrowing into an actual loan with an agreement in writing with specific terms and records so that the terms and conditions of the loan tick all the boxes for the minimum requirements of what is called a Division 7A loan. This requires a minimum rate of interest and certain sorts of repayments, security, and all sorts of other terms and conditions. Basically, each year after the loan is made, the Division 7A loan will have interest charged and be subject to a minimum repayment. This can sometimes be met by making the minimum repayment through paying an actual dividend, which will obviously be less than the loan amount, so that it has a very long-term effect of stretching and giving a stream of income subject to smooth tax, rather than very lumpy, for example, $300,000 in one year or each year. Division 7A loans can also be a strategy for highly profitable businesses to lend surplus profits, which may accumulate, to a director on a secured basis, where they might seek to use that loan in place of going to a bank. For example, the director might be looking at buying an investment property. Rather than borrowing from a bank, use the internal capital. Alternatively, it might be wise to consider other strategies for asset protection to diminish the holding of liquidity in the company to ensure that other investment options can be considered. For example, acquiring business premises and things like that. So there's a lot of strategies that can be used very effectively with the right knowledge and advice, and all it takes is asking a question. So we suggest you discuss with your advisor how to manage and use Division 7A to better effect if you're affected. Contrary to popular belief, this is the most common thing we hear is, but I can pull the money out of my business, I park the funds in my offset, and I save interest on my home, and I just put it back at the end of the year. If you believe that, you've actually breached Division 7A. That is not the case. We hear this commonly from people who have used advisors who may not be as proficient on tax law and practice as they certainly should be. So have a word with your advisor, have a word with us, and we're more than happy to discuss how we can assist you. And we hope you found that interesting. We hope you found it helpful. And we hope you enjoy further videos in this series or one of our other channels. Right. Thanks for now. Bye.